Crush your mortgage loan originator exam with Birdsy.ai. Master mortgage terms and concepts to pass your license test fast. And don't miss what's happening in the lower corner. It's your invite to try a proven new way to ace your exam. More on that in a minute. Now, let's dive in.
Let's begin with a look at loan types and products. Conventional versus government loans. Which loan type is specifically designed to assist rural homebuyers? Is it A, Federal Housing Administration, FHA loans, B, U.S. Department of Veterans Affairs, VA loans, C, U.S. Department of Agriculture, USDA loans, or D, conventional loans? The answer is C, U.S. Department of Agriculture, USDA loans. USDA loans are government-backed loans designed to help low to moderate income individuals purchase homes in rural areas. They offer benefits like no down payment and reduced mortgage insurance costs. Which loan type might require private mortgage insurance if the down payment is less than 20%? Is it A, U.S. Department of Veterans Affairs, VA loans, B, Federal Housing Administration, FHA loans, C, U.S. Department of Agriculture, USDA loans, or D, conventional loans? The answer is D, conventional loans. Conventional loans often require PMI when the borrower makes a down payment of less than 20%. This insurance protects the lender in case of borrower default, increasing the loan's cost.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to Birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
Which loan type is often associated with the requirement of an upfront mortgage insurance premium? Is it A, conventional loans, B, Federal Housing Administration, FHA loans, C, U.S. Department of Veterans Affairs, VA loans, or D, U.S. Department of Agriculture, USDA loans? The answer is B, Federal Housing Administration, FHA loans. FHA loans require borrowers to pay an upfront mortgage insurance premium at closing, which is typically 1.75% of the loan amount. This fee helps protect the lender against losses. Which type of loan is not backed by any government agency, leading to potentially stricter qualification criteria? Is it A, Federal Housing Administration, FHA loans, B, U.S. Department of Veterans Affairs, VA loans, C, conventional loans, or D, U.S. Department of Agriculture, USDA loans? The answer is C, conventional loans. Conventional loans are not backed by any government agency, making them riskier for lenders. As a result, they often have stricter qualification criteria, including higher credit scores and larger down payments. Fixed rate, adjustable rate, and hybrid loans. What is the primary risk associated with an adjustable rate mortgage for borrowers? Is it A, interest rate increases, B, interest rate decreases, C, fixed monthly payments, or D, early repayment penalties? The answer is A, interest rate increases. The primary risk of an ARM is the potential for interest rate increases, which can lead to higher monthly payments. This unpredictability can affect a borrower's ability to budget effectively. Which type of mortgage might be ideal for a borrower planning to sell their home within 5 years? Is it A, 30-year fixed-rate mortgage, B, 15-year fixed-rate mortgage, C, interest-only mortgage, or D, a hybrid adjustable rate mortgage? The answer is D, a hybrid adjustable rate mortgage. A hybrid ARM could be ideal for short-term homeowners due to its low initial fixed rate period, which often aligns with short-term occupancy plans, minimizing interest costs before the rate adjusts. How does a fixed-rate mortgage benefit borrowers during periods of rising interest rates? Is it A, predictable payments. B, adjustable payments. C, lower initial rates. Or D, rate caps. The answer is A, predictable payments. A fixed-rate mortgage protects borrowers from rising interest rates by locking in a consistent interest rate and monthly payment, ensuring predictable housing costs regardless of market fluctuations. What feature of a hybrid ARM differentiates it from a traditional ARM? Is it A, adjustable from inception? B, initial fixed-rate period? C, no interest rate changes? Or D, interest-only payments? The answer is B, initial fixed-rate period. A hybrid ARM starts with a fixed interest rate for a set period before transitioning to an adjustable rate. This feature provides initial stability, unlike traditional ARMs, which adjust rates periodically from the start.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Balloon loans, interest-only loans, reverse mortgages. What is a common requirement for obtaining a reverse mortgage? Is it A, a credit score above 700? B, a minimum home value of $500,000? C, borrower must be at least 62 years old? Or D, a history of timely mortgage payments? The answer is C, borrower must be at least 62 years old. To qualify for a reverse mortgage, borrowers typically need to be at least 62 years old. This product is designed to help older homeowners convert their home equity into cash. Which of the following best describes a balloon loan? Is it A, a loan with equal monthly payments throughout its term? B, a loan with smaller periodic payments and a large final payment? C, a loan that requires interest payments only for its entire term? Or D, a loan that increases the principal balance over time? The answer is B, a loan with smaller periodic payments and a large final payment. A balloon loan features smaller periodic payments with a large final payment due at the end of the loan term. This structure can be risky if the borrower cannot refinance or pay the balloon payment. What is a primary characteristic of an interest-only loan? Is it A, the principal is paid down from the start? B, the loan balance increases over time? C, only interest payments are required initially? Or D, the loan is forgiven after a certain period? The answer is C, only interest payments are required initially. Interest-only loans require borrowers to pay only the interest for a set period, after which they must start paying down the principal. This can lead to lower initial payments, but higher future payments. Which factor is critical for a borrower considering a reverse mortgage? Is it A, age requirement of 62 years or older? B, requirement to make monthly payments? C, fixed interest rate throughout the loan term? Or D, loan forgiveness after a set period? The answer is A, age requirement of 62 years or older. A reverse mortgage allows homeowners 62 and older to convert home equity into cash without monthly payments. The loan becomes due when the borrower moves out, sells the home, or passes away. Loan process terminology: prequalification, preapproval, and underwriting. During which stage of the loan process is a borrower's employment history typically verified? Is it A, prequalification? B, preapproval? C, underwriting? Or D, closing? The answer is C, underwriting. Employment history is typically verified during the underwriting process. This stage involves a thorough review of the borrower's financial background to assess risk and loan eligibility. What is a key characteristic of the pre-approval process in the loan application? Is it A, it includes a conditional commitment from the lender? B, it is based solely on verbal information from the borrower? C. It is a non-binding estimate of borrowing capacity. Or D. It guarantees loan approval without further checks. The answer is A. It includes a conditional commitment from the lender. Preapproval involves a formal review of a borrower's credit report and financial documents, providing a conditional commitment from the lender, subject to final approval and property appraisal. In the context of mortgage underwriting, what is the significance of the debt-to-income ratio? Is it A. It helps assess the borrower's ability to manage monthly payments. B. It determines the interest rate offered to the borrower. C. It is used to verify the borrower's employment status. Or D. It guarantees that the borrower will receive the loan. The answer is A. It helps assess the borrower's ability to manage monthly payments. The debt-to-income ratio is crucial in underwriting, as it measures a borrower's ability to manage monthly payments and repay debts. Lenders use it to assess financial health and risk. How does the underwriting process differ from pre-approval in the mortgage loan process? Is it A. Underwriting is less detailed than pre-approval. B. Pre-approval includes property appraisal, unlike underwriting. C. Both processes provide a final loan commitment. Or D. Underwriting involves a detailed financial risk assessment. The answer is D. Underwriting involves a detailed financial risk assessment. Underwriting involves a comprehensive risk assessment, including verification of financial information and property appraisal, whereas pre-approval is a preliminary review providing a conditional loan commitment. Disclosures: loan estimate, closing disclosure. What is the purpose of the closing disclosure in the mortgage loan process? Is it A. To estimate the initial loan costs? B. To outline the final terms and costs of the loan? C. To provide a summary of the borrower's credit score? Or D. To replace the loan estimate? The answer is B. To outline the final terms and costs of the loan. The closing disclosure provides borrowers with a detailed account of the final costs and terms of the mortgage loan. It ensures transparency and allows borrowers to confirm loan details before finalizing the transaction. Which of the following is a key feature of the loan estimate document? Is it A. It helps borrowers compare loan offers. B. It details the borrower's repayment history. C. It is issued after loan closing. Or D. It replaces the closing disclosure. The answer is A. It helps borrowers compare loan offers. The loan estimate provides borrowers with a clear summary of the terms and estimated costs of a mortgage loan, helping them compare offers from different lenders early in the process. What is a significant difference between a loan estimate and a closing disclosure? Is it A. The loan estimate is provided after the loan closes? B. The closing disclosure estimates future interest rates? C. The loan estimate provides initial estimates while the closing disclosure confirms final costs? Or D. The closing disclosure includes the borrower's employment history? The answer is C. The loan estimate provides initial estimates while the closing disclosure confirms final costs. The loan estimate provides initial cost estimates and terms, while the closing disclosure confirms the final costs and terms of the loan. This distinction helps borrowers understand changes in costs throughout the process. Loan application components. What role does the 1003 form play in the mortgage loan process? Is it A. It collects necessary borrower information for underwriting? B. It serves as a legal agreement between borrower and lender? C. It determines the interest rate for the mortgage? Or D. It appraises the property value? The answer is A. It collects necessary borrower information for underwriting. The 1003 form, or URLA, is essential in the mortgage loan process as it collects all necessary borrower information for underwriting It serves as a comprehensive record for lenders to make informed decisions on loan approvals. Which section of the 1003 form typically requires the borrower to provide details about their assets and liabilities? Is it A, employment information, B, assets and liabilities, C, declaration, or D, borrower information? The answer is B, assets and liabilities. The 1003 form, also known as the Uniform Residential Loan Application, includes a section where borrowers must disclose their assets and liabilities. This information helps lenders assess financial stability and creditworthiness. What information is primarily collected in the Property Information and Purpose of Loan section of the URLA? Is it A, borrower's employment history, B, borrower's credit history, C, borrower's income details, or D, details about the property and loan purpose? The answer is D, details about the property and loan purpose. The Property Information and Purpose of Loan section of the URLA gathers details about the property being financed and the intended use of the loan, such as purchase or refinance. Financial and qualification terms, debt-to-income and loan-to-value ratios. Which of the following best describes the relationship between the debt-to-income ratio and a borrower's ability to secure a loan? Is it A, a higher DTI ratio improves loan eligibility, B, DTI ratio is irrelevant to loan approval, C, a lower DTI ratio enhances loan approval chances, or D, DTI ratio affects only interest rates, not loan approval? The answer is C, a lower DTI ratio enhances loan approval chances. A lower DTI ratio indicates that a borrower has more income available relative to their debt obligations, making them more attractive to lenders and increasing their chances of securing a loan. What impact does a high loan-to-value ratio have on a borrower's mortgage terms? Is it A, it may lead to higher interest rates, B, it guarantees lower monthly payments, C, it has no effect on the mortgage terms, or D, it ensures the borrower gets a larger loan? The answer is A, it may lead to higher interest rates. A high LTV ratio indicates a smaller down payment, increasing the lender's risk. This often results in higher interest rates or the requirement for mortgage insurance to mitigate risk. Why might a borrower with a low loan-to-value ratio be considered a lower risk by lenders? Is it A, because they have a higher debt load, B, because they are likely to default, C, because their property value is decreasing, or D, because they have invested more equity? The answer is D, because they have invested more equity. A low LTV ratio implies that the borrower has made a substantial down payment, reducing the lender's exposure to loss if the property value decreases or if the borrower defaults. Front-end and back-end ratios. What is the typical maximum front-end ratio lenders prefer for conventional loans? Is it A, 36%, B, 28%, C, 45%, or D, 50%? The answer is B, 28%. Lenders typically prefer a front-end ratio of 28% or less for conventional loans, ensuring that housing costs remain a manageable portion of the borrower's income. Why is it important to calculate both front-end and back-end ratios when assessing a borrower's financial health? Is it A, to evaluate housing and total debt burden, B, to determine property value, C, to set interest rates, or D, to assess employment history? The answer is A, to evaluate housing and total debt burden. Calculating both ratios provides a comprehensive view of a borrower's financial obligations, ensuring they can manage housing costs and total debt, thus reducing default risk. Which of the following best describes the back-end ratio in mortgage lending? Is it A, it calculates only housing-related expenses, B, It compares total monthly debt payments to gross monthly income. C. It is used to determine the interest rate on a mortgage. Or D. It focuses solely on the borrower's credit score. The answer is B. It compares total monthly debt payments to gross monthly income. The back-end ratio measures a borrower's total monthly debt obligations compared to their gross monthly income. It provides a comprehensive view of the borrower's financial commitments, helping lenders assess risk. Points, yield spread premium, origination fee. What is the typical relationship between yield spread premium and borrower costs? Is it A. Reduces borrower costs? B. YSP has no impact on borrower costs? C. YSP increases borrower costs? Or D. YSP is unrelated to borrower costs? The answer is C. YSP increases borrower costs. Yield spread premiums typically result in higher borrower costs because they are associated with loans offered at higher interest rates, which increase the overall cost of the loan over time. In mortgage terms, what does points refer to? Is it A. a measure of loan risk? B. fees paid to reduce interest rates? C. a type of loan insurance? Or D. a method of calculating monthly payments? The answer is B. fees paid to reduce interest rates. In mortgage terms, points refer to fees paid to the lender at closing in exchange for a reduced interest rate. Each point typically costs 1% of the loan amount and can lower the interest rate.
Stuck on a question? Just think of the Birdsy link in the description as your friendly neighborhood superhero swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Which statement accurately describes how an origination fee is typically calculated in a mortgage loan? Is it A. as a fixed dollar amount regardless of the loan size? B. as a percentage of the loan amount? C. based on the borrower's credit score? Or D. as a rebate to the borrower? The answer is B. as a percentage of the loan amount. An origination fee is usually calculated as a percentage of the total loan amount. It compensates the lender for processing the loan and is often negotiable. Mortgage-related documents. Promissory note, deed of trust, mortgage. Which document in a mortgage transaction specifies the borrower's promise to repay the loan and outlines the terms of repayment? Is it A. deed of trust? B. promissory note? C. mortgage? Or D. title insurance? The answer is B. promissory note. A promissory note is a legal document in which the borrower agrees to repay the loan under specified terms. It does not convey any interest in the property, but is crucial for outlining repayment obligations. Which document is typically recorded in public records to provide constructive notice of a property's lien status? Is it A. promissory note? B. deed of trust? C. mortgage? Or D. title insurance? The answer is C. mortgage. A mortgage is recorded in public records to establish a lien on the property, providing notice to potential buyers or lenders of the existing debt. This recording protects the lender's interest. What role does a trustee play in a deed of trust? Is it A. holds the property title as security? B. provides loan funds to the borrower? C. insures the property against loss? Or D. appraises the property value? The answer is A. holds the property title as security. In a deed of trust, the trustee holds the title to the property as security for the loan. If the borrower defaults, the trustee can initiate foreclosure proceedings on behalf of the lender. Which document outlines the terms and conditions of a loan but does not convey any interest in the property? Is it A. deed of trust? B. promissory note? C. mortgage? Or D. title deed? The answer is B. promissory note. A promissory note details the borrower's promise to repay the loan, including terms and conditions, but it does not convey any property interest. It is a financial obligation, not a property document. Escrow, impounds, and servicing. What is an impound account in relation to a mortgage? Is it A, an account for holding the borrower's mortgage payments? B, a savings account for future home improvements? C, an account for managing closing costs? Or D, an account for property taxes and insurance premiums? The answer is D, an account for property taxes and insurance premiums. An impound account, also known as an escrow account, is used to collect and manage funds for property taxes and insurance premiums. This ensures timely payments and protects the lender's interest in the property. Which of the following best describes mortgage servicing? Is it A, the process of originating a new mortgage loan? B, the management of a mortgage loan after closing? C, the process of refinancing an existing mortgage? Or D, the sale of a mortgage loan to another lender? The answer is B, the management of a mortgage loan after closing. Mortgage servicing involves the management of the loan after closing, including collecting payments, maintaining records, and handling escrow accounts. Servicers ensure that all aspects of the loan are managed according to the terms. Which of the following is a common reason for a lender to adjust the amount held in an escrow account? Is it A, increase in the borrower's income? B, changes in the loan interest rate? C, fluctuations in property taxes or insurance premiums? Or D, modification of the loan term? The answer is C, fluctuations in property taxes or insurance premiums. Lenders adjust escrow accounts to ensure adequate funds for property taxes and insurance premiums. Changes in these costs require adjusting the escrow to prevent shortages or surpluses. Regulatory and compliance terms. Truth in Lending, RESPA, the Equal Credit Opportunity Act, the Home Mortgage Disclosure Act, and the SAFE Act. Which act requires lenders to disclose the annual percentage rate and other loan terms to borrowers before they commit to a loan? Is it A, Truth in Lending Act? B, Real Estate Settlement Procedures Act? C, Equal Credit Opportunity Act? Or D, Home Mortgage Disclosure Act? The answer is A, Truth in Lending Act. The Truth in Lending Act mandates that lenders disclose the APR and other critical loan terms to ensure borrowers can compare loan offers and understand the cost of credit. Under the SAFE Act, which entity is responsible for maintaining the nationwide multi-state licensing system and registry? Is it A, Federal Reserve Board? B, Consumer Financial Protection Bureau? C, Conference of State Bank Supervisors? Or D, Federal Housing Finance Agency? The answer is C, Conference of State Bank Supervisors. The Conference of State Bank Supervisors and the American Association of Residential Mortgage Regulators jointly maintain the NMLS to enhance consumer protection and support mortgage industry oversight. Which regulation requires lenders to provide borrowers with a closing disclosure 3 business days before closing on a mortgage loan? Is it A, Home Mortgage Disclosure Act? B, Equal Credit Opportunity Act? C, the SAFE Act? Or D, TILA-RESPA Integrated Disclosure Rule? The answer is D, TILA-RESPA Integrated Disclosure Rule. The TILA-RESPA Integrated Disclosure Rule combines TILA and RESPA disclosures, requiring lenders to provide a closing disclosure to ensure borrowers understand final loan terms and costs. Trigger terms, APR, Charm Booklet. What is the consequence of using a trigger term in a mortgage advertisement? Is it A, additional disclosures must be included? B, the advertisement must be withdrawn? C, a higher interest rate must be offered? Or D, the advertisement must be approved by a regulatory body? The answer is A, additional disclosures must be included. Using a trigger term in advertising necessitates the inclusion of additional disclosures, such as the APR and terms of repayment, to ensure consumers receive comprehensive information. In the context of mortgage lending, what does APR stand for, and why is it important? Is it A, annual payment rate, B, annual percentage rate, C, adjusted payment rate, or D, amortized percentage rate? The answer is B, annual percentage rate. APR stands for annual percentage rate. It is crucial because it provides borrowers with a clear understanding of the total cost of the loan, including interest and fees, expressed annually. Ethics and industry conduct. Redlining, steering, blockbusting. What is a common misconception about the practice of steering in real estate? Is it A, it benefits buyers by guiding them to suitable areas? B, it is a legal requirement in some states? C, it ensures fair housing practices? Or D, it promotes diversity in housing communities? The answer is A, it benefits buyers by guiding them to suitable areas. A common misconception is that steering benefits buyers by guiding them to appropriate areas, but it actually restricts choices and perpetuates discrimination. Which of the following best describes the unethical practice of steering in the real estate industry? Is it A, encouraging buyers to consider multiple neighborhoods? B, offering financial incentives for specific property purchases? C, directing clients to neighborhoods based on racial composition? Or D, providing detailed information about local amenities? The answer is C, directing clients to neighborhoods based on racial composition. Steering involves guiding potential buyers towards or away from certain neighborhoods based on race or ethnicity, limiting their housing choices and perpetuating segregation. Fraud for housing versus fraud for profit. Why is fraud for profit considered more harmful to the financial system than fraud for housing? Is it A, it involves more borrowers? B, it is harder to detect? C, it often involves higher amounts of money? Or D, it undermines market integrity? The answer is D, it undermines market integrity. Fraud for profit involves systemic manipulation by industry insiders, leading to larger financial losses and undermining market integrity. Which of the following actions would most likely be categorized as fraud for housing? Is it A, creating fake companies to secure multiple loans? B, falsifying employment details to qualify for a mortgage? C, using a false appraisal to flip a property? Or D, colluding with a lender to approve unqualified buyers? The answer is B, falsifying employment details to qualify for a mortgage. Fraud for housing involves individuals falsifying information to secure or maintain a mortgage, typically for personal use rather than financial gain. Borrower misrepresentation and predatory lending. What is a potential consequence of borrower misrepresentation? Is it A, increased loan approval rates? B, better interest rates? C, loan default and foreclosure? Or D, higher credit scores? The answer is C, loan default and foreclosure. Misrepresentation can lead to loan default and foreclosure, as the borrower may not be able to meet the financial obligations, ultimately resulting in loss of property and credit damage. Which practice is a red flag for predatory lending? Is it A, loan flipping? B, offering fixed-rate mortgages? C, providing first-time buyer discounts? Or D, requiring home inspections? The answer is A, loan flipping. Loan flipping occurs when a lender encourages repeated refinancing, generating fees without benefit to the borrower. This practice can trap borrowers in a cycle of debt. Which of the following scenarios exemplifies borrower misrepresentation? Is it A, a borrower accurately reports their income but omits a part-time job? B, A borrower uses a cosigner to improve loan terms. C. A borrower falsifies income documents to qualify for a larger loan. Or D. A borrower negotiates a lower interest rate with their lender. The answer is C. A borrower falsifies income documents to qualify for a larger loan. Borrower misrepresentation occurs when a borrower provides false information to secure a loan. This could involve falsifying income documents or misrepresenting employment status to meet loan qualifications.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit Birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.